Ladies and gentlemen, focus your attention on the silver price on your screen, because what you are witnessing is not a rally, but the early phase of a historic market rupture. Just days ago, silver was trading quietly, but within a thin holiday market it exploded upward, reminding us that low liquidity turns small imbalances into violent price discoveries. This period between Christmas and New Year is known as Ghost Week, when traders vanish, liquidity evaporates, and prices no longer move in cents, but in dollars. In that vacuum, silver didn't climb politely. It detonated vertically, ripping through old resistance levels as if they never existed in the first place. When an asset breaks its all-time high, there is no overhead supply, no trapped sellers, and no historical ceiling to slow momentum. Everyone holding silver is suddenly in profit, and when that happens, price stops taking the stairs and starts taking the elevator. In a single trading session, silver printed a massive daily candle, a move that would normally take months compressed into hours. This is why dismissing the move as a bubble misses the point, because bubbles are noisy, crowded, and celebrated, while this move is still ignored. Turn on mainstream financial media and you will hear silence, because the stealth phase of a bull market always hides in plain sight. That silence is not a coincidence, it is your edge, because the public cannot chase what it does not yet understand. Silver is now outperforming stocks, cryptocurrencies, and indices, yet it remains absent from most institutional headlines. This disconnect tells us we are not near a top, but rather approaching the moment when awareness begins to spread uncontrollably. Large daily price swings cannot be hidden forever, and charts that go vertical eventually force attention from the biggest players. Those players are not just retail investors, but pension funds, sovereign wealth funds, and institutions managing trillions in capital. These institutions do not act on emotion, they act on mathematical triggers embedded deep inside their allocation models. One of those triggers is the gold to silver ratio, a simple number that quietly governs massive capital flows. When that ratio compresses sharply, it sends a signal that silver is historically undervalued relative to gold. That signal does not whisper, it screams across institutional dashboards around the world. Once triggered, those models rebalance automatically, regardless of headlines, opinions, or short-term volatility. What you are seeing now is the market front-running that mechanical demand before the largest buyers even return from holiday. As institutions prepare to return, traders understand that the next phase is not emotional speculation, but mechanical buying driven by strict allocation mandates. Pension funds do not debate headlines. They rebalance portfolios when ratios cross predefined thresholds embedded deep within their risk models. When the gold to silver ratio falls below critical historical levels, silver becomes mathematically unavoidable for large capital pools. For years, the ratio sat elevated, signaling gold dominance and relegating silver to an industrial afterthought in institutional portfolios. That regime has now broken, and the sudden compression of the ratio has flipped the signal from ignore to accumulate. To a portfolio manager overseeing trillions, this shift represents a textbook arbitrage opportunity, not a speculative gamble. Allocators seeking precious metals exposure suddenly realize silver offers significantly more upside per dollar than gold. This realization triggers capital rotation, where gold positions are trimmed and silver positions are built aggressively. In large markets, a few $100 million is noise, but in silver, it becomes a seismic event. Silver's market depth is shallow, meaning even modest institutional flows can overwhelm available liquidity. This imbalance forces prices higher not because of excitement, but because supply simply cannot absorb demand. Traders active during Ghost Week understand this dynamic and are racing to secure inventory ahead of institutional orders. They are not buying to hold long term, but to sell into the wave of forced demand arriving next week. This behavior accelerates price discovery, compressing what should be months of movement into days. As price rises, short positions held by banks begin to feel acute pressure. These shorts were built under assumptions of abundant liquidity and manageable volatility. Those assumptions no longer apply in a market experiencing structural imbalance. When institutions collide with heavily shorted banks, volatility does not smooth out, it intensifies. This creates a market environment where sharp drops and violent recoveries coexist within the same session. Understanding this structure is critical, because the danger ahead lies not in direction, but in speed. This velocity-driven market creates conditions where price can collapse briefly without invalidating the broader structural bullish trend. These sudden drops are not signs of weakness, but deliberate attempts to exploit thin liquidity and trigger emotional selling. Banks under pressure understand psychology, and they use sharp downside moves to flush out over-leveraged participants. In this environment, leverage becomes the primary enemy, not market direction or long-term fundamentals. A trader can be perfectly right about silver's future and still be wiped out by a 10-minute price shock. This is why seasoned participants focus on positioning, not prediction, when volatility reaches extreme levels. Physical holders experience these swings differently because volatility does not threaten their ownership. When prices flash crash, physical holders simply observe, while leveraged traders face forced liquidation. This divergence creates a transfer of metal from weak hands into strong hands during moments of chaos. Each violent shakeout removes supply from the market, tightening conditions for the next upward move. As these events repeat, the market structure becomes increasingly hostile to short sellers. Banks attempting to suppress price risk being overwhelmed by waves of automatic institutional buying. Any engineered dip quickly turns into an opportunity for large funds forced to meet allocation targets. This traps short sellers in a narrowing corridor with fewer and fewer exits. At the same time, global physical demand continues rising, independent of futures market volatility. Industrial users cannot pause production simply because prices are volatile. Their demand creates a hard floor beneath the market that paper selling cannot easily penetrate. As price swings widen, confidence in paper contracts begins to erode. Participants increasingly question whether future delivery will actually be honored. This doubt shifts behavior away from speculation and toward immediate physical acquisition. This transition from paper confidence to physical urgency marks a critical inflection point in every historic commodity bull market. When delivery risk enters the conversation, price no longer reflects speculation, but availability. Silver inventories are finite, visible, and already stretched across industrial, investment, and monetary demand. Unlike digital assets, silver cannot be created instantly to satisfy rising global appetite. Every ounce purchased for immediate delivery removes flexibility from the system. As inventories thin, futures markets become increasingly fragile and reactive. Any disruption, whether logistical or geopolitical, now carries outsized price consequences. This fragility explains why price movements feel discontinuous rather than smooth. Markets shift from orderly auctions into gap-driven repricing events. Participants expecting gradual trends are caught off guard by sudden vertical adjustments. Historically, this phase precedes explosive upside rather than exhaustion. The reason is simple. Demand has become inelastic while supply remains constrained. Industrial consumption continues regardless of price because silver is irreplaceable in key technologies. Energy infrastructure, electronics, and medical applications cannot substitute silver without redesign. This locks in baseline demand even as investment flows accelerate. At the same time, mining output responds slowly, measured in years rather than quarters. New supply cannot arrive fast enough to neutralize surging interest. This mismatch compresses the market into a coiled spring. Each pause builds potential energy for the next violent release. When that release occurs, price discovery becomes chaotic and unforgiving. At this stage, traditional valuation models lose relevance because price is no longer set by theory but by urgency and fear of shortage. Analysts searching for fair value discover that fair value disappears when buyers compete for limited physical supply. Silver transitions from a traded asset into a rationed commodity. Allocation decisions shift from optimization towards simple availability. Whoever secures metal first gains an advantage that price alone cannot replicate. This is when long-term contracts begin to fracture under delivery pressure. Counterparty trust becomes more important than quoted prices on a screen. Buyers start favoring known suppliers with proven delivery histories. Smaller buyers are pushed out, not by price, but by access. The market quietly stratifies into insiders with supply and outsiders without it. As this divide grows, volatility accelerates further. Each rumor of shortage triggers preemptive buying. These actions amplify feedback loops already present in the system. Price spikes become less frequent but far more violent. Consolidations shorten as patience evaporates. Market participants stop waiting for pullbacks that never fully arrive. This behavior signals a psychological regime change. Silver is no longer viewed as cheap or expensive, but as necessary. Necessity transforms speculative interest into strategic accumulation. From this point forward, timing matters less than participation. Historically, this is the moment when silver disconnects from conventional market correlations and begins trading as its own scarcity-driven system. Equity sell-offs no longer suppress silver, and bond rallies fail to cap its advances. Correlations that traders relied upon for decades begin to fracture without warning. Risk models calibrated to normal conditions start producing misleading signals. This mispricing creates confusion among macro traders accustomed to stable relationships. Silver no longer behaves like a hedge or a trade, but like a critical input under threat. When capital recognizes this shift, allocation size increases dramatically. A 1% portfolio adjustment becomes a structural commitment. For large funds, that difference represents billions of dollars. Those billions cannot enter the silver market quietly. Each incremental allocation pushes price disproportionately higher. Liquidity vanishes faster than expected, amplifying every order. This produces price gaps that appear irrational to traditional analysts. In reality, these gaps reflect a market repricing under duress. The public still views silver as volatile and dangerous, unaware that volatility is now asymmetric upward. Downside risk becomes brief and violent, while upside risk becomes extended and relentless. This asymmetry defines the most profitable but psychologically difficult phase. Investors hesitate, waiting for clarity that never arrives. Meanwhile, price continues advancing in uneven but persistent waves. By the time clarity appears, accessibility has already vanished. At this late stage, participation becomes restricted not by belief, but by availability, logistics, and trust in counterparties. Investors who delayed now face widening bid-ask spreads and shrinking deliverable inventories. Premiums detach from spot prices, signaling stress within the physical market. Paper quotes lose authority as real-world transactions dictate true clearing levels. This divergence exposes the limits of price discovery on futures exchanges. Exchanges function smoothly only when delivery is assumed, not demanded. When demand shifts toward fulfillment, systemic weaknesses surface rapidly. Rule changes, margin adjustments, and trading halts become more frequent. These measures aim to slow price, but often amplify distrust instead. Participants interpret intervention as confirmation of scarcity rather than stability. Confidence migrates away from paper venues toward direct ownership channels. Vaults, refiners, and mints replace screens as the center of attention. The market narrative shifts from charts to logistics. Questions change from price forecasts to delivery timelines. In this phase, time becomes more valuable than money. Delayed access carries opportunity costs that pricing models cannot quantify. Buyers compete not just on price, but on reliability and relationships. Strategic partnerships displace anonymous transactions. Silver becomes embedded into long-term planning rather than short-term trading. At that point, volatility signals transition, not termination. Historically, this final transition phase is where silver stops behaving like a market and starts behaving like a strategic resource. Governments, utilities, and manufacturers quietly reassess long-term access rather than short-term price fluctuations. National stockpiles become topics of internal discussion instead of public disclosure. Strategic reserves are evaluated not for profit, but for continuity and security. This silent demand layer operates beyond charts, headlines, and sentiment indicators. It enters the market methodically, absorbing supply without broadcasting intent. By the time its presence is detected, available inventories are already depleted. At that point, price becomes a secondary consideration to certainty of delivery. This is when silver's role shifts from investment asset to systemic necessity. Monetary demand, industrial demand, and strategic demand converge simultaneously. That convergence creates pressure no exchange mechanism was designed to handle. Volatility escalates not because of speculation, but because systems strain under load. Market signals become distorted as intervention attempts lag real-world conditions. Traditional tools lose effectiveness in restoring equilibrium. Resolution comes only through dramatically higher prices or forced demand destruction. Historically, markets choose price first. That repricing is fast, disorderly, and psychologically destabilizing. Observers mistake this phase for collapse when it is actually culmination. The silver market does not fail here. It reveals its true clearing price. What follows is not a return to normal, but the establishment of a new baseline.